We just happen to have a woman here today who is a mom on the one hand, a great investor, and also a protege of Paul Jones. Kathleen Kelly is founder of Queen Anne's Gate Capital, a global macro hedge fund with a focus on commodities based here in New York. Now, Kathleen, we are going to spend plenty of time talking with you and with Rick about investing, but we really can't ignore this issue. Why? Because you had 2 children while you were working for Paul Tudor Jones.
As a macro trader.
As a macro trader. So what was he trying to say?
You know, I actually am a macro trader because of Paul Jones, because I was hired as an economist from the Fed to go and work for Tudor, and at some point Paul pulled me into his office and said, you should be a trader. So I can safely say that Paul is a big proponent of women and has been a great mentor to me and continues to be now. So I think, you know, what he's highlighted is that there is a problem, that there's not enough women in these roles. And the question is then, what's the solution for that, right? And there's a few things that people should start looking at. They should start thinking about filling the pipeline for women in the investment space. So looking at telling your daughters to take more math and STEM courses, and focusing more on probabilities and statistics, because as Paul was saying, it takes an incredible amount of focus. And it is, at the end of the day, something that global macro markets trade 24 hours a day. So we have to really either choose our time zones or be available 24 hours. So having that math and statistics background is going to make it a lot easier. And also supporting women that have women-owned firms, because that's going to provide more role models and more opportunities for other women.
But bottom line, do you think he was misunderstood in saying that to trade macro successfully on this 24-hour high-paced basis, you can't have children?
No, that's not what he was saying. He was saying it takes incredible focus, and he was saying it's difficult, more difficult for women because they have so many things pulling at them, and it is more difficult for women in any role because they have more things pulling at them, but we still manage to do it and do it well.
Rick, there are lots of people at BlackRock who trade, if not macro, they trade with macro focus, macro mindset. You know, what kinds of accommodations do you need to, if any, do you need to make to acknowledge what Kathleen is saying?
Yeah, I mean, some of our best PMs and traders are women. I mean, one of the things we've done, I think some other firms have done, you be more flexible about timing, more flexible about when are people working from home, or allow them to work from home. And, you know, quite frankly, I mean, it is to have a diverse atmosphere, I've found over the years, is actually where you have a more successful investment paradigm. So anyway, I just think you have to be, I think the point that Kathleen made is right, just be more flexible around it.
Notion of a commodity super cycle, the years of higher commodities prices fueled by the boom in emerging markets growth. Is there such a thing?
There might be a super cycle in finding and producing commodities, I think, that we're starting to see instead. There's no commodities super cycle in our mind. We think that through technological enhancements and productivity gains, you find commodities where you thought you weren't going to get them before. So you see the U.S. is at the record high crude production, if you include ethanol in there, record high natural gas production. We see you know, substitutes away from cotton into polyester. We see substitutes away from copper into plastics. And so there's a lot of opportunities for us to use technology to get away from being resource constrained.
So it sounds like that's how you're looking for opportunities, rather than, say, a blanket view, positive on emerging markets because China's voracious appetite and construction boom is going to fuel these prices.
Right. When we look at China, we think about the intensity of use. And when you think about the last decade and what China's focused on, it's manufacturing, building manufacturing capacity and building airports. And these days, looking at water treatment, looking at sewage, that's a much different usage of commodities. It goes away from base metals and much more towards cement. So we don't think that, we think people look at these intensity of usage charts and just think that it's going to go on forever. But we've seen really significant changes in the underlying economies, and that changes their need for commodities.
Premier Li, Chinese Premier Li, was quoted today as saying that China is now targeting 7% growth, because 7% is what it needs to double per capita GDP by 2020. And it has been about 10%. The last couple of years, Chinese growth has been sort of in the 8.5% range. What does it say to you, Rick, when, you know, one of the senior members of Chinese leadership says we're no longer targeting something close to 10%?
I think it's a statement of reality. I think China's going to be slowing. I think they have to rein in the lending dynamic, which has been such a tremendous driver of growth. So that has to come down. The real estate dynamic, which was such a big driver of the growth, won't be there to the extent that it was. And then you also had this incredible labor advantage that has deteriorated. So it is a fact of life that growth is going to be slowing. 7% growth, still decent growth, but it is clearly slower than it's been.
Is that already what commodities markets acknowledge, that China isn't going to grow at a rate of 7% or more?
It's part of it. I think when you looked at the beginning of this year, people were still looking for growth above 8%. And so people are ratcheting down slowly their Chinese forecast. I don't think really people are much below 7.5 though still. But I think that commodities are disengaged from the overall markets because what's driving commodities is not liquidity per se, it's demand. And demand has just not been as strong as we've seen weaker growth in Europe and weaker growth in China, whereas asset markets are really being driven in a large part to liquidity.
When I hear you say demand and asset markets, I think precious metals, gold and silver, the shine has been taken off of these markets lately. Do you like any of them?
So we've had a negative view on precious metals and platinum and palladium, and the reason has been that if you're a macro investor and you're sitting there in 2008 with a 5 to 10 year time horizon, you're really worried about asset prices, you're worried about negative yields, and you're worried about the dollar declining. And so at that point it probably made sense to look at the gold ETF as a place to protect your capital. But you're not getting any yield there, and the price has actually been declining for 2 years because gold prices topped out in 2011. If you're sitting here today looking at the macro environment going out 5 to 10 years, you're probably looking at yields going up, you're looking at asset prices doing okay, and you're probably looking at a stronger dollar because the U.S. looks like you've got a better shape than most other places. So why own gold?
So I gave a presentation that gave the exact same depiction of that. You had to own gold for the prior couple of years. We owned them in some of our flexible fixed income funds because the monetary base in this country went up 5 times over the last 10 or 12 years. You had to own gold to some extent as a protection. Fed's not going to double the monetary base again. It's not going to, and so we're at a point where it's slowing. The question I always have, though, is people ask all the time, so what is the right price for gold? And I'm not sure what that is. I know that you don't have to own it, and I don't have to own it in some of my funds today.
Right. So we look at everything on a supply-demand analysis, and gold is the one commodity that you can't model that way because there is this investor base that wants to hold it no matter what. And so, but we think that the fair value on a supply-demand analysis in gold is significantly lower here. And you've taken 14 million ounces out of the global gold ETFs right now, but there's still 70 million ounces in there. And those 70 million ounce holders have to be thinking, do they want to sit here with no yield going forward? So that's significant supply that could come back to the market.